Well, hello, this is Hall Martin with Investor Connect. Today we're here with Andrew Goldner of GrowthX. Andrew, thank you for joining us.
It's my pleasure, Hall. I'm grateful for the opportunity to be on your show.
Can you give us a little bit of your background and how you got to where you are today and also about GrowthX?
Sure. Quickly, I started my career 20 years ago as a lawyer in the technology space. I had a firm in New York serving some of the Silicon Alley and Silicon Valley early pioneers, AltaVista, Yahoo, Salesforce, DoubleClick. And through that journey, I've taken roles as corp dev. I've taken the role as the founder, now, of course, as one of the founders of GrowthX, a seed stage venture capital fund and platform based in the Valley and investing outside of the Valley.
Great. And tell us a little more about GrowthX and what you guys are doing there today.
Sure. GrowthX is a venture platform that's deploying capital, talent, and know-how. We're most active with our capital at the seed stage, but we're broadly active around innovation from idea stage all the way through public company. We have 4 pillars: GrowthX Capital, GrowthX Academy, GrowthX Corporate, and our Market Acceleration Program. Everything is designed around a core principle, which is identifying the best founders where they are and earning the opportunity to invest by being helpful. And where we help is where we think help is needed the most, and that's around marketing and sales. We know statistically nowadays 70% of the companies that are funded fail, and 80% of the reasons why they fail have to do with the behaviors of the people and the market. They're not failing because the product doesn't work. We spend our time helping product-focused founders understand the market development side of the world. GrowthX Capital is our seed stage fund that's based in the Valley. We're attracting technologists and companies anywhere that are disrupting the global B2B landscape. GrowthX Academy is our training program that's focused on critical sales, marketing, and UX competencies, helping companies, frankly, at every stage execute and commercialize innovation, both folks that want to work in it and those that are already in it in a corporation need retraining. GrowthX Corporate is our innovation advisory for those corporate partners. It helps them validate the internal and external market opportunities that they have and source early stage technology partners kind of as our entrepreneur in residence for them. And also it helps them implement corporate venture capital best practices. We believe that venture is a very important part of the corporate innovation agenda. And so we work with late stage public companies on that. And of course, our Market Acceleration Program, which is our private accelerator for companies that are GrowthX Capital portfolio companies. And it helps them test and develop and validate the hypotheses they have early on at every stage of the market development process. And they work all in tandem together, and it helps us relevant from, like I say, idea stage through public company.
Well, great. Well, you've been in the venture capital space for quite some time, and it seems like the VC space is changing pretty dramatically right now. Can you talk a little bit about the trends and what's driving the change in the venture capital landscape, and where is it going?
That's a great question. One of the views that I have is the real pleasure that I've had, the opportunity that I've been afforded to spend the last year and a half as a Kauffman Fellow. Not only is it providing me access to some of the best practitioners around the world, and that, of course, gives me a view of those trends. I think there are many. I think off the top of my head, to name just 3, I'd certainly talk about investment, venture capital beyond the Valley, primarily, which accounts for nearly 50% of all venture capital globally. If you just add in greater Boston area and the greater New York City area, you've got over 65% of venture dollars globally being spent just in those 3 places. I do think one of the great trends is venture beyond those 3 primary places and really just Silicon Valley, both in the emerging economies around the United States as well as the emerging economies around the world. I think there's more and more opportunity to deploy capital by helping founders to stay proximate to their customer rather than forcing them to be proximate to their capitalists. And how to do that as a venture fund, how to be present in areas that currently and traditionally have collectively added up to much less of the venture dollar spend that has traditionally been the case, as in Silicon Valley, is a trend that we're starting to see take more and more shape. Obviously, we've been talking about this for quite some time. Steve Case and the rise of the rest. You have great practitioners at Village Capital, at Lewis and Clark Capital, at Drive Capital, Drive Capital is a great example. Top practitioners from the Valley who understand that most of the GDP in this country is a 12-hour drive from Columbus, Ohio, and thus the name Drive Capital being based in Columbus, Ohio. So I think that trend is absolutely changing the landscape of venture capital. And again, those examples are in the United States, but you can take a variety of other examples, such as Golden Gate Ventures, Vinny Loria, who pioneered venture in Southeast Asia and is one of the leading life forces behind what had been a nascent space and has now gained a significant amount of traction. I would say venture as a platform is a trend that is becoming more prevalent. The pioneer, obviously, being Mark Andreessen, Ben Horowitz, the most well-known VC platform, Andreessen Horowitz, very broad with a significant amount of resources to deploy far beyond the checks they write. If you take a look at the resources that are available to the portfolio companies at Andreessen Horowitz, it's true acceleration without really calling themselves an accelerator or running as a traditional, what we would know as an accelerator. I think more and more venture capitalists are coming up with not only novel hypotheses beyond I'm the smartest person in the room and I have access to deals that nobody else does. I don't think that argument wins the day anymore with limited partners. And I think as more founders become more savvy and more ventures being deployed, there's more of an eye towards being helpful to the founder beyond writing the check. And a traditional VC, with the resources available with the 2 and 20 model, typically are good at maybe taking a board seat, certainly opening up the network to downstream funders and also to top talent for recruitment purposes. But if you take a look at the venture platforms as pioneered by Andreessen, there is a deep well of talent that's being brought onto the platform to help the founders in the portfolio and, of course, to attract top founders into the portfolio. Frankly, we've been described as the Andreessen of the seed stage. We certainly take that as a compliment. So if you go back to my introduction where I talked about GrowthX Capital Academy Corporate and our Market Acceleration Program, it's precisely for that purpose. There's a lot of undifferentiated dollars at the seed stage. Putting more dollars into the system at the seed stage is not going to solve the problem. The Series A crunch is only getting worse. But helping founders where they need it the most, for us, our lane is entrepreneurial selling, business development, user experience design. That's our lane. But I think you're starting to see more and more venture capitalists, both in the Valley and globally, building platforms to support the success of the entrepreneur beyond the checks that they're writing. I guess the third one would be corporate venture capital. It's been around for a while, since Intel Capital, but I think it's been sidelined until recently. I think primarily because of the way that corporates had historically approached investing off the balance sheet, without a mandate, without a money manager, without a real plan or understanding about the goals for a financial return versus a variety of strategic returns that it can provide a corporation. I think companies are getting smarter. As they get smarter about innovation, all of us are moving in the fourth industrial revolution, the innovation economy. And I think corporates are getting better at understanding that research and development is not innovation, and they need to bridge that gap. I think they're doing a better job about strategizing around innovation, although I do think there still remains a large gap with corporates having the capability to execute on innovation. But I do think that more corporates are thinking more seriously, and rightly so, about making sure that venture is a part of the innovation agenda and that it has to be done well with a plan in mind, with a set of experiences which are often not the same experiences as folks doing M&A, certainly not the GMs and the stewards of the P&Ls. So understanding how to organize that and to create the objectives and execute on them, I think more companies are thinking about that. And therefore, that's changing venture capital. The VC dollars from corporates had historically been shunned And now they're being welcomed. And by the way, they're being welcomed at an earlier stage.
Well, with corporate VCs, I often get them coming in saying, hey, we want to invest in this deal. Can you go find a financial VC to paper it up for us? And so it seemed like they're still coming up the curve a little bit on actually engaging at the VC level with companies and technologies, making more formalized funds, making more formalized partners who can really drive those funds forward with due diligence, as opposed to having just a business development manager kind of caretake what's going on. How long do you think that's going to be before the corporate VCs get to the same level as the financial VCs in the structure, fund, and due diligence?
Well, listen, I think it's happening. And if you take, I don't know the exact statistics, but I can tell you the trend is certainly in favor of more and more corporate dollars as a percentage of the pool of venture that's being deployed, and certainly at the earlier stages. Now, when you talk about stages in venture capital, and I probably should have named this as one of my top 3 trends, I like to joke that A is the 5th letter of the alphabet now in venture capital. Because technology is cheaper and easier to deploy than it ever has been, and technologists are more plentiful than they ever have been, the seed is now what the A was 5 or 6 years ago. And that's changing too. You now have pre-seed funds in the valley. You seeing a series seed, a priced round at the seed stage is not uncommon. But I would project that in the near future, you're going to see a pre-seed round of preferred stock that's being created. The stages of the funding life cycle are changing because we're transitioning from the age of developed technology into the age of applied technology. And that has to do with the corporate playing as well, because they're playing at what is an earlier stage and they typically have been involved. I can tell you in our experience, more companies are thinking more seriously about venture. Those that are and historically have been involved are spending more of their capital, are getting better at the internal biz dev opportunities for the startups within the companies as they invest. They're stepping up to lead rounds, and those are things that didn't historically happen. I think companies that had made some willy-nilly investments off the balance sheet and got turned off by it are now coming back to it with a more thoughtful approach. And again, it's not in a vacuum. Where we see the venture capital conversation within the corporates happening now is as a part of that greater innovation agenda, which also includes relationships with the technologists and the startups, which includes the talent to execute on innovation as opposed to just strategize about it. And that, of course, includes the conversation about a fund structure as opposed to just investing off the balance sheet. Listen, some of the hangover in corporate America is similar to the hangover among what were casual angel investors who had acquired some capital through the sale of a company who or otherwise just got turned on to wanting to spend some of their capital in this asset class. It's an interesting thing to talk about at a cocktail party. They spent $50, $100, $200,000 here and there on a handful of companies. They didn't get to know the company founders very well. They didn't have an investment thesis. They didn't have a background in money management. And of course, we know at the seed stage, a significant number of your investments are going to go belly up, and it takes 7 to 10 years for them to turn around. These same investors that saw 20% annual returns on their real estate said, why would I waste my money more on this silly asset class, and just got turned off on it. And that money went to the sidelines. Very much like I see corporates coming back in and being more thoughtful about it. I see some of the same angel community coming back with some of the tools and the resources and the media and the information that's more and more out there about how to do VC in a more thoughtful, professional way. I think more of that is coming back. So the short answer is I see the trend continuing. I see corporates playing a larger role because I think they're getting better. And I think as information spreads more rapidly, you just have more companies that want to avoid being taxi in the Yahoo.
Well, you mentioned that the VCs are putting in a lot more resource to help the startups grow. I don't think there's any VC that's not founder friendly, but it seems like the definition of founder friendly is going to the next level of being more founder secure, founder promotional, where they really do more than just be friendly to the founder, but they actually are committed to helping them grow, and they're putting in more formalized accelerator programs like you are and other supports. Where do you see that going? What's going to be the new standard for VCs in order to even be considered for their funding?
I think that's a great question. We reject, at GrowthX, we entirely reject the notion of founder friendliness because it presumes a transaction. And we don't operate transactionally, we operate relationally. If you're operating on a relational level, it's about building long-term, healthy, sustainable relationships. It's about being transparent. It's about seeking fit. It's not about objection handling. It's not about selling. It's not about closing the opportunity. And it's not about being founder friendly. When we meet a founder and we have the opportunity to learn about what they're working on, the first thing that we do is we express our gratitude. And I hope that we talk again in a year or two and you ask the same question. I hope one of the top trends that I talk about is gratefulness and mindfulness among the venture capital profession, because I think it's important, I think it's needed, and it's certainly the way that we practice our profession at GrowthX. And so I do reject, and we at GrowthX reject that notion of founder friendliness because we just don't approach it from a transactional perspective. I think some of that is underlying that platform experience. I think taking a holistic approach and viewing this not as a deal and not as the deployment of capital and not as a transaction is how you get to a better long-term healthy result, especially as it becomes more and more obvious. Again, back to that statistic, 70% of the funding companies fail, 80% of the reasons have to do with the behavior of the people and the market, not the product. It's not about features and functionality. And so much of it is just about the behavior of the people. And so building platforms that not only include someone who's an expert at growth or someone who is an expert on attracting and retaining top engineering talent, but also someone who practices behavioral fitness and can help the founder understand the importance of whole body, of healthy eating, of exercise, of practicing mindfulness. Those things, I think, are going to become equally important on the platform as some of the more traditional ways that you can help founders.
Great, great. Well, those are all good trends to watch as they unfold in the VC world. In our last minute remaining, what did we not cover that you wish we had to wrap it up?
Well, it's a deep subject that's important right now. It's also a trend that we didn't talk about, and that's welcoming diversity into the venture capital profession. I think it's critical. When I sit around a table and make an important decision, the last thing I want, in my case, is a bunch of white men around that table helping me make that decision. Having a diversity of perspective, seeing more people of color, and certainly seeing more women comfortable with the profession, and the underlying behavioral changes that need to take place in the profession so that we welcome this group in is important. It's going to make the profession better. It's going to make our returns better. But GrowthX, our first fund, is nearly 40% female founder. That wasn't on purpose. We don't have a mandate from our limited partners to invest in women, but we do take everybody seriously. We are grateful for the opportunity, and I think that has welcomed that, and it's performing as a result of it. We're a better fund, we're a better partnership because of that diversity, and we hope to find that same outcome with people of color. So it's a trend. It's an important trend. I think the issues have to be addressed. I think the profession would improve as a result of it. And I think founders and funders that get together and make this pledge together is going to improve the profession. It's a subject for a whole conversation, but it would be unfortunate if we didn't just touch upon it.
Well, certainly that's a good topic for our next interview. As we close out this one, what's the best way for people to get in touch with you?
Always happy to hear from people through hello@growthx.com. Again, as I said, we're grateful for the opportunity to meet founders and hear what they're working on. Help is our most important form of due diligence. We love discovering how we can be helpful. That takes the form of capital, that's great. But what we seek is an opportunity to build a relationship around helpfulness. And so please reach out if you think that there's a way for us to be helpful to you.
Well, that's great. We appreciate your taking time, and we look forward to seeing you next time.
Paul, thank you again.